Corporate Finance Presentation Measure of Risk. Get ready, it's time to take your chance with corporate finance. We're thinking about risk as it relates to our capital budgeting and investment type decisions, those investment decisions that are going to have an impact multiple periods into the future. And risk is going to be measuring the uncertainty. So it's the variable of future outcome from an investment, measures uncertainty in the investment. So the general rule, as we discussed in prior presentations, is that two components we're looking at, expected return and risk. Obviously, we want our expected return to be as high as possible, and in general, we would like the risk to be as low as possible. In the event where we're measuring projects where the risk is going up and the return is going up, then we want to be able to consider whether or not the added return warrants the added risk. So the statistical tools that we'll take a look at, and the best way to practice these statistical tools is to work through practice problems. We will have many practice problems to work with them, will be the statistical concepts of the population mean. This can also be called basically the average or the expected value. These are going to be the terms that you might see for, in essence, the mean calculation. And notice when you think about these calculations, oftentimes you think about them as we start off in statistics, learning them with a series of numbers, a data set of numbers. And then we're going to apply them to a little bit different of a structure here. And the population mean will basically be the expected value when we think about them with our future component of analysis. We will talk about that more in our practice problems, the transition from basically analyzing just a list of numbers possibly, where you first saw some of these terms, and then applying them to our future decision-making process. And of course, there's a lot more analysis, great material out there for mathematical concepts, statistical analysis, and so on that you can look up on YouTube or the internet with your favorite browser. We then have the population variance, which will be this calculation. We'll talk more about the calculations as we go through the practice problems. We just want to list them out for now. We have the standard deviation, and then we have the coefficient of variation. Now, note, for our purposes, as we're projecting into the future, we're oftentimes going to be looking at the mean, basically the average, because that's going to be, in essence, our expected value. In other words, if we have multiple things that we think could happen, we run multiple projections into the future, then typically we take the average, the mean average, the expected value, and think that that's going to be what we expect to happen. Then we want to think about what's going to be the variance from the mean, what's the spread from the mean, because that's going to help us with the determination as to the risk that will be involved. Now, the calculations for that from a statistical analysis could include the population variance and the standard variance, the standard deviation. But oftentimes when we're thinking about capital projects into the future, they have different investment amounts. Therefore, we'll be concentrating in oftentimes with the coefficient of variation to help us to measure the risk. So the two terms we're typically going to be looking at with regards to the two questions we have, one, expected value, that's going to be our average, the expected value, the mean in essence of what we believe the expected outcomes could be, and then the coefficient of variation, which is going to be helping us to determine the level of risk. Now, of course, to get to this bottom line number, the coefficient of variation, we're going to need to calculate the standard deviation to get there. You need the standard deviation, and you need to calculate the population variance to get to the standard deviation. From a statistical point of view, of course, the better you understand about all the concepts and how they're going to be related to each other, the better you are. So if you want to go from a mathematical standpoint, just in terms of the analysis of data, then again, a lot of material you can look up on that. So if we have our three different scenarios, once again, let's say this is scenario 1, A, B, C, and D, and we're going to say that A, B, C, and D represent different values that we expect could happen in the future. So we could have then, we have A being 1,000, B being the 2,000 return, C being the 3,000 return. In this case, we would say that B would be our expected value, basically the average in this case. So we're going to say this is going to be our expected value. The question then is going to be, how likely is the data set to be lying outside the expected value? Now note, this gets a little confusing because we're not talking about a data set that basically already happened or analyzing a big population. We're trying to use these concepts to analyze the future, what we're going to think in the future. So the more spread out the data is from the mean, the concept is, meaning this data set is more spread out from the center point, has more likelihood that a point that lands in here will be somewhere outside the middle point then in this chart, and this chart is going to be more spread out. So the general rule is the likelihood of the data that's going to be spread out more from the center point is going to give us more risk. Now, the typical kind of calculation for that would be the standard deviation. So the standard deviation would help us to say, okay, here's the data points that we expect to be happening. How likely are they going to be falling into a certain section if we were to graph them as basically a bell curve, right? That's going to be the concept of it, and the more likely, so that would mean the greater the standard deviation that we have, the more there is variance, and that would be an indication that you have more risk. Now, the problem with the standard deviation is that we could be dealing with projects that have different expected values. So in other words, if this middle term here, the average is different, which it well could be, given the fact that when we're talking about capital projects, we could be comparing projects that are completely different in nature, and the level of years that could be involved could be different, and a whole bunch of components could be different. So if we have two projects that have different values for the expected value, this first one, for example, having 5,000, standard deviation of 400, then compared to this one that has an expected value of only 500, which is the center point, in essence, the average or the mean, in essence, the standard deviation is going to be 150. Notice this one has a less standard deviation than this one, which would lead you to believe that this one, then, if you were just to look at the standard deviation, would have less risk. But that's not generally the case here, because this one has a much higher expected value. And you can see that from just the graphical representation, that it looks like the data is going to be more centered towards the middle, which means that you would think it would have less risk, where this one is going to have more data that looks like it's towards the tails, which means that you would think that it would have more risk. And that, of course, is the result of the relationship between the standard deviation calculation in dollars as compared to the expected value, or basically the average here versus here. So this number doesn't tell us as much by itself when comparing, once again, different projects that have different expected value. The solution to that, then, is to use the coefficient of variation, which is going to take that standard deviation and divide it by the mean, or the average, or the expected value. In essence, you can basically think of those three terms as kind of like the same thing when you're jumping back and forth from statistics. Statistics is going to call it the mean. Any average person on the street is going to call it the average. Excel is going to call it the average. And here we're basically calling it an expected value. So for the most part, you can pretty much switch those out. So then if this one we'll use to remove the problem caused by the different investment sizes. So now once we do this calculation, we'll come up with a term which by itself wouldn't tell us too much about the data, but when compared to another project, such as these two projects, could then give us a comparison to help us to see the spread of the data in a relative way, and that can help us with our calculation of risk. So those are going to be the standard two terms we'll look at. It's going to be the expected value, and then we're not going to spend a lot of time on the standard deviation due to the fact that we're measuring things of different sizes typically, and we'll jump on over to the coefficient of variation generally. So best way to get an idea of that is just to work practice problems. We'll do a lot of practice problems. So then we have the beta, the risk measure commonly used with relation to the portfolio of common stocks. When we're thinking about common stock, we can use other kind of methods because we have like indexes and the market to help us out with that. We're not going to spend as much time here because we're focusing in on those capital projects oftentimes and using these tools for the capital projects where we don't have the benefit of the indexes. So it measures volatility of returns on individual stock relative to the returns on the stock market index. Then we have the capital budgeting factors. So we have the expected return and the risk. So remember, whenever you're thinking about these decisions, investment decisions in general, and of course with these capital budgeting decisions as a type of investment decision, these are the two things that we are weighting out. Also note that the larger the decision is, then the more important it is to get the balance right the first time. In other words, if you're investing in something that's a short-term investment, then, and like stocks, and you're trading stocks and you could trade them around from period to period, then you have some leeway to try to test things out, see if it worked, and then test it out again. You can do a trial and error. You can tinker with something. But these capital budgeting decisions, remember, are different in nature. you can't tinker with a capital budgeting decision, because if you're buying a whole nother property, or if you're buying a whole factory of a factory in order to, or doing a large merger or something like that, or buying a big piece of equipment, just like on the personal side, buying a new car or something, that thing's going to last you for some time. So it's not like you can say, I tried this decision and now I'll try something else tomorrow and see if it works out better or worse. There's some types of decisions that you just don't have that option. And on those types of decisions, you have to basically what they call measure twice, cut once. Just like if you're measuring the door frame, you don't want to cut the piece of wood too short the first time because you can't redo it there. You got to go buy a new piece of wood. So with these capital budgeting decisions, because they're long-term decisions, we want to, of course, spend more time to get this measure right than we might do on a normal day-to-day like managerial type of decisions. Obviously, the expected return, we want to maximize the expected return if we can. We want to minimize the risk, which generally means we want to minimize the variance that could be from the expected value that we would take place. Generally, that means that note that if the expected return goes up, oftentimes expected return goes up and it includes a higher level of risk. That's typically the case. But remember, the fact that risk goes up, the risk going up is not the thing that is pulling up the expected return. Risk could go up and expected return may not. And those are the things we want to weed out. If expected return goes up on a particular project, it's likely that risk will go up, but it's also likely that risk can easily go up without expected return going up. So in a situation where the expected return does not go up and risk goes up, then of course we want to pick the project that's going to have the better expected return and the lower risk. In the situation where expected return goes up and risk goes up, then we have to measure whether or not the risk that is going up is worth it with regards to the return that we're going to possibly get, the higher expected return, and we can measure that on an individual investment standpoint, as well as how does it fit in our overall company structure, our investment portfolio in essence, to mitigate risk on that level.